Hello, and welcome to Portfolio Matters Weekly Update, week 59. And it has been a very dramatic week in markets and around the world as Russia has invaded Ukraine. And so this week, we are going to go through essentially all the financial assets that have been affected, and there will be profound disruptions to commodities. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, let's get into the review.
Okay, before we get going, a reminder, we can all meet to drown our sorrows on the 9th of March at the City of York pub, High Holborn. I hope to see everyone there. Okay, news. Well, the big news of the week was Russia did what the US and the UK had been saying it was going to do all along and invaded Ukraine on all fronts. And I had absolutely got this wrong, along with a lot of other commentators. I didn't believe Putin would actually invade. In fact, earlier in the week when he announced that he was recognizing the two breakaway provinces in eastern Ukraine, I thought that was it. But I was wrong. Fundamentally, I thought he was a rational individual rather than a murderous, lying psychopath. And now we have war in Europe, which I hope to never see in my lifetime. So, Richard, your thoughts?
Well, I think it's an epoch-changing event, Keith. I think it completely turns on its head the geopolitics of Europe. I think that it's very difficult to understand what Putin might do next and whether he'll go for the other Baltic states, which are Lithuania, Latvia, and Estonia, which are also members of the EU and members of NATO. And if he were to do that on the basis of having successfully annexed Ukraine, that would, according to all tenets of international law currently standing, that would result in a European-wide war with America joining in.
Yes.
And I think I have great difficulty in understanding where Putin might draw the line.
See, I think he's made a huge mistake. I think the reason I didn't think he would invade is that I think these days the experience since the Second World War has been that it is very difficult to conquer a nation that doesn't want to be conquered and successfully occupy it, because the moment you get into urban environments, you get unending guerrilla war. And the only way to suppress that is through repression, which is unacceptable to most countries. So European countries, such as when we took over Iraq, essentially found it very difficult to hold because we faced unending guerrilla warfare. Go on.
I would agree with that, but if martial law is viciously imposed on Ukraine, then guerrilla war becomes almost impossible. So I think that if Putin's role, if Putin wants to do that, he can achieve it. I think it gets very, very messy. But I don't think we're in a position to say he'll fail. I actually think he'll succeed. I think he can succeed. I think he has the military and economic levers to succeed with Ukraine. And I think that's one of the problems, that he will succeed. Also, the fact that he has strung along and displayed utter contempt for European and American attempts to negotiate.
Well, we can only wait and see. Okay, so the effect of the Russian invasion was profound. So the Russian stock market fell almost 50% and is now down 2/3 since December. But the biggest effect will be on energy prices. So there's likely to be disrupted gas flows to Europe, which is heavily dependent on Russian energy supplies. And the FT are estimating that there will be GDP hits to Europe. So for every 10% rise in the gas price, they're estimating that they will have a 0.3% effect on Eurozone GDP. And fertilizer, Belarus and Russia are big exporters of fertilizer, and that will hit fertilizer prices and food production going forward. And thinking about the winners and losers, it is quite easy to think of commodities which will go up in price because Russia is a huge commodity exporter. So produces 18% of world export volumes of coal, although that mainly goes to China and the Far East. Produces 40% of world palladium, 6% of aluminium, 7% of nickel, 4% of cobalt, 3.5% of copper, 29% of grains come from Russia and Ukraine. And we've seen a spike in wheat and corn prices, and we'll go through that. Between them, Russia and Belarus produce 25% of world potash. And neon. See, the world supply chain is so complex now. The neon is an essential component of semiconductor production and is produced as a byproduct of Russian steel manufacturing. Now, in 2014, the neon price spiked by 600% the last time Russia attacked Ukraine. So there are going to be lots of knock-on effects, not all of which are predictable. Other winners will be arms manufacturers. So we've seen British Aerospace shares spike, possibly supermarkets, as we get general inflation and they can try and disguise a bit of margin inflation amongst that, and safe haven assets. Now, the losers will be, well, I would say risk assets of all kind, but we've seen in the US that equities actually bounced and ended the day up, which is in line with our forecasts of last week. Now, banks have had a bad couple of days on the back of the likelihood of financial disruption and lower interest rates going forward. Travel will face higher fuel costs and also disruption in flight schedules and lower consumer confidence. Lots of sectors will face higher fuel costs. Ukrainian and Russian assets have obviously been hammered, but above all, higher inflation all over the place. Richard, any thoughts?
No, basically, I agree that what I would say is that the dust has yet to settle. In fact, the dust is still rising. And I think this is a sort of first stab at sectors that might be affected and how they might be affected, but remains to be seen ultimately what the overall effect is on stock markets and risk assets. And I was very struck yesterday by the volt fast the markets did. I mean, gold was up 4%, down 2% in the same day. Silver was up 7%, 5%, down 2% in the same day. Crypto was basically down 10% and closed pretty much flat. So there's huge volatility, and it's going to take a while to determine what the longer term effects will be.
Yeah. Now, last week we talked about how a lot of assets actually do all right from the start of a war. Essentially, a lot of the falls have already happened before the shooting starts. And so these are charts of the performance of the S&P 500 during previous wars, and you'll see that actually the shooting has tended to be the start of a rally in a lot of cases. And that is absolutely the case this time so far. So the Dow Jones, it dropped substantially on the open, but then recovered through the course of the day and actually ended up. The S&P had an absolutely extraordinary day, ended up 1.5%. The NASDAQ ended up 3.3%. Extraordinary. And this is from a full-blown invasion in Europe. Okay, so the UK has announced sanctions. VTB Bank will face a full asset freeze. Russian banks can no longer use the UK financial system or sterling for payments. Russian companies will be banned from raising funds in London. Further, as yet unspecified sanctions against Belarus, asset freeze on 100 named entities and individuals, an export ban on dual-use technology. What is notable is that none of the countries announcing sanctions so far have announced sanctions on Russian energy exports because they don't want to impact European consumers or US consumers. But we have been supplying the Russians with this, the NLAW anti-tank missile, and according to media reports, the Ukrainians have knocked out a few Russian tanks with them, which is good news. Okay, this week's economic data. Now, I've kept this brief because, frankly, I think all of this is going to be largely out of date. We have to see what happens now. But we had various PMIs last week, and they were all good. They all exceeded expectations. So the US composite was expected at 51.9. It came in at 56, substantially beating expectations. EU, again, expected at 52.5, came in at 55.8. UK expected at 55, came in at 60.2. So the West, seems that the purchasing managers indexes are all stronger than expected. Now, the other piece of data I would highlight is UK car manufacturing, which was expected to be only minus 2.3% and actually came in at minus 20% year on year, which was worse than January and much, much worse than expectations. And that suggests that supply chain problems are persisting. Richard, do you want to do the charts?
I mean, in some senses, it seems a little bit bizarre to be talking about US existing home sales in early 2022 when Russia's just invaded Ukraine.
Yeah.
And I suspect that the full extent of the impact of it hasn't yet registered on many people. But it's also very difficult to know how it will impact the US, because the US is obviously geographically a long way away. But obviously, US existing home sales are continuing to do well, as we've talked about over the last couple of weeks. Case-Shiller house price index year on year is slightly leveling off. I mean, there's not enough data to know whether the trend is changing there, but there's reason to suspect it may change with changes to interest rates.
Now, we actually featured this chart 3 weeks ago, and this chart is from the St. Louis Fed, and it was showing a sharp drop in the median sales price for new houses sold in the US, which seems to directly contradict the Case-Shiller house price index, which is still showing almost 20% year-on-year growth. So I'm not quite sure how we interpret the contradictions between these two charts. We'll have to see how the data develops in subsequent months.
Yeah. So US manufacturing PMIs seem to have steadied around about 55, which is good. US service PMI, nothing really to remark on there. It's
well, they've both seen a nice bounce, I'd say.
Yeah, they have, haven't they? But I mean, it's very difficult to comment on such a short-term move because it's quite a volatile chart, isn't it, Keith? It's sort of in the middle of the range that persisted between 2017, say, and 2020. And same with the composite PMI. And EU manufacturing PMI is looking quite healthy still, as we've commented before. So as is the services PMI. So EU composite PMI. UK manufacturing PMI is steady, despite the fact we had this big drop in car production, which seems slightly contradictory.
Yeah, British Aerospace are going full out producing guns, I would have thought.
Yeah. And services PMI is looking pretty healthy, actually, in the UK. And there's composite. UK consumer confidence took a really big hit in the latest survey. I don't know if we know why, whether it's inflation and taxes. I saw that there was a headline: Rishi Sunak wants to move, doesn't like high taxes, but he's putting them up anyway. So he's trying to sit on both sides of the fence.
Yeah. Well, I think rising energy bills just about to hit. Inflation's everywhere. It's not really surprising.
No. Yes, initial jobless claims have definitely stabilized. They've been steady now for the past 4 months or so. As have, although this is the weekly chart, isn't it? But the US continuing jobless claims also seem to have stabilized.
Yeah. Okay, so in place of our usual sections, we are going to just run through all the asset prices that have been affected by the war in Ukraine. Now, these were all done late last night. So this is the first day's effect, basically. So wheat spiked because Russia and Ukraine collectively export a lot of wheat, as they do corn, which also spiked. Aluminium up, cobalt up a tiny bit, copper pretty much flat, nickel had a good week, platinum actually fell, surprisingly, as Russia's an exporter of platinum. Palladium, they produce 40% of the world's palladium, and palladium actually fell. Gold jumped, silver jumped a bit. Bitcoin, so this is the intraday charts, and Richard talked about this earlier. So Bitcoin has revealed itself to be a risk asset rather than a safe haven asset, I would say, because that is following the NASDAQ rather than gold.
Yep.
Ethereum the same. Now, Dutch natural gas prices spiked hard, and Europe now has a profound energy problem. So Germany has explicitly ruled out sanctioning Nord Stream 2, but still gets a lot of its energy supplies from Russia. And there will be ongoing uncertainty about gas supplies, and that will on its own lead to elevated prices.
It'd be interesting to see whether Germany finally reversed their policy of closing down the last few nuclear power stations that they've got, or whether they are turkeys voting for Christmas.
Yeah, I think they will still vote for Christmas.
Yeah.
So German electricity prices actually only showed a small rise, which is very surprising, because I would have thought the rise in the natural gas price would lead to a big spike, but that's not been the case so far. Although, of course, they are 2.5 times. This is the UK natural gas price, which also spiked. We only get about 8% of our gas from Russia, but we will still need to buy our marginal supply from either Europe or from LNG supplies around the world. And so we are also exposed to this.
I think Germany gets something like 45% of its gas from Russia, doesn't it?
Yeah.
A very large number, very exposed.
UK electricity prices rose slightly. Now, we don't have daily charts for fertilizer prices, but Bloomberg are reporting that urea prices, so that's nitrogen fertilizer prices in New Orleans, rose to $700 a ton yesterday from $560 last week. So that's over a 20% rise. Oil price shot up to well over $100 a barrel before settling down late last night to around $99 a barrel. Coal was up slightly, showed little effect. The Russian stock market took a huge bath. The Russian ruble dropped. The Ukrainian hryvnia fell heavily as well, unsurprisingly. There was safe haven buying of the US dollar. But surprisingly, there was very little safe haven buying of US bonds. So we've seen people actually buy risk assets such as the NASDAQ and avoid treasuries, which is interesting. But they've certainly been selling Russian bonds, the yield of which has shot up to 12.7%. There appears to have been some buying of German 10-year, and bear in mind the ECB are making noises about delaying interest rate rises, and that has also benefited Italian and Greek bonds, although Greece just a touch. And my conclusion from reviewing all of that is that Richard's prediction of last year seems sadly to be coming true. We have all the elements in place for stagflation. Richard.
Yeah, what bothers me particularly, Keith, is that the people who are predicting that inflation is going to drop back to 2% or so over the course of the next 9 months. I know that's the sort of a prediction I've seen in several places over the course of the last few weeks, including, I think, the ECB and probably the Bank of England, and never mind the Fed. But my concern is, and this isn't meant to sound conceited at all, but I think they personally, I think they misunderstand the nature of this inflation. And I read again yesterday that someone saying, it was in the Financial Times actually, comment in the Financial Times, someone saying people don't understand that the labour market is no longer unionised, and therefore pricing power in the labour market is much diminished over how it was in the 70s. I disagree. I don't think people need a union to be able to organise themselves to go on strike if they think they're not being paid enough. I think they'll just do it, or they'll organise themselves at that time. So I think that is a false conclusion. So I think the causes of inflation are very complicated. Much are to do with the supply chain. We also have clearly the supply chain is going to be further disrupted by what's going on in Europe with the Ukraine, significantly further disrupted. I think we will get a wage price spiral because inflation is so high that people can't not have significant pay increases in order to manage their household finances. And we are starting to see nascent, what we've seen in the UK, falls in consumer confidence. Central banks have to run a system of financial repression, which means interest rates have to stay low, significantly lower than inflation. The market has been sustained by QE, and QE is going to be taken off the table, possibly, probably, is it, maybe. And all of that, to my mind, does mean that there's a significant risk of, I think in some, of stagflation in some senses. I think it's debatable as to whether we're already in it.
Yes.
So, yeah. And then, of course, which we come on to, doubtless, the issue is, what do you do with your personal finances in those circumstances.
Mm. Well, I'll make a couple of points, Richard. First of all, on the wages, I think you're absolutely right. You don't need unions because, I mean, just look at the quits rate. People are leaving for higher paid jobs at an extraordinary rate. So in order to retain your staff, you need to raise wages, or you need to attract staff, you need to raise them even more. So we are seeing definitely strong wage rises, particularly in the service sector. On inflation, I mean, the fundamental cause of inflation is an excess of demand over supply. And the cause of the current inflation was we pumped loads of money and fiscal stimulus into the economy and gave people lots of money to spend, so they went out and spent it. But now we are moving into an environment where the poor cause is not excess demand, it's the fact that supply of a lot of absolutely crucial commodities is going to be reduced. And therefore, you will have inflation, and you're going to have to reduce demand to the point where the two balance.
Yeah, I agree.
So on that note, moving on to Inflation Watch. So no new data this week, but to recap, already UK CPI is at 5.5%, US at 7.5%, EU at 5.1%, Germany at 4.9%. And I thought this was a very good and important chart that I found on Twitter from Stephen Van Meter. And basically, if you look at this, whenever inflation spikes, in order to get it down again, essentially, you need a recession. The grey vertical stripes are recessions. It's only very rarely, it's actually in 2005, you did have a big fall in inflation, but when you get inflation at 7.5%, it only comes down through recession. So that is something we really need to be aware of.
Yeah. And the recession, of course, reduces demand, and reduces employment, and reduces the pricing power of employees.
Yeah, because fundamentally, if there's less oil and energy available, then you need to reduce demand, i.e. economic activity, until the two balance again. And that involves a recession. But so far, the central bank's strategy of talking about how inflation will naturally come down on its own and not doing anything about it has been very good for the national debt, which has been reducing as a percentage of GDP. Now, good news, supply chain bottlenecks appear to be easing. So this is the backlog of container ships waiting entry to Los Angeles ports, and the time taken to unload a container ship has fallen very substantially. So that is all good news for the supply chain. But German PPI in January hit 25%, and we know that we've just had huge spikes in natural gas prices and lots of other commodities. This is likely to be persistent, and rising oil prices will affect almost everything, frankly. But this is ship fuel. Running through some charts of US economic activity from Yardeni Research, this chart basically shows that supply chain disruptions are falling. So the red line is the backlog of orders, which is easing, and supplier delivery wait times are also falling back. So that's good news. Unfulfilled orders are still elevated, but down from their peak. As Richard talked about, wages are rising. Now, producer price inflation, has that begun to ease? Some signs for goods inflation? I thought this was interesting. This shows historic experience of wages following pandemics. Now, this does go back to the Black Death in 1311. So, there's it is not adjusted for the severity of the pandemic, I believe. But still, as you would expect, shortage of workers are following a pandemic tends to lead to wage rises. And a reminder, we have inflation because we pump the world full of money. So the blue line is the US, which had broad money growth of over 30%. Sorry, that's 25%, sorry, in 2021. And the Eurozone had it over 12%. And unsurprisingly, the US is having stronger inflation now than the rest of the world. The two are not separate. And as a result of that, there's just more money around. So people are going to spend it. Now, the only other section we're going to do this week is on potash prices, because we have been struggling with this for a couple of weeks. So this is the chart of Murato Potash free on board Vancouver. And we posted this chart a couple of weeks ago stating that the prices seem to be very stable. But then our farmer viewer, Hugh Evans, pointed out that the UK price for him was $720 a ton, which is massively higher than the Vancouver price. So what is going on? Well, this chart from the National Farmers Union in the UK shows that there has always been a very substantial gap between UK farm prices and international prices, and that can only be transport costs. So transport costs are very substantial. And we know that during the pandemic, the cost of transporting dry bulk commodities around the world absolutely spiked, but has since come back down. So you would expect the transport component of potash prices to have also spiked. But this chart, which shows the price of potash around the world, also shows that there's been a big spike in the potash price. So that leads me to think that our data is wrong, that the data for the Vancouver free on board price does not appear to be correct, although it is the same. The chart is the same as that of this prevailing China seaborne contract price. So it makes me wonder whether one is long-term contracts and the other is short-term. And you'll notice that the World Bank also appear to use the Vancouver price for Murato Potash, and they're not showing a spike. But the USDA is reporting that Illinois potash prices have more than doubled last year. So this is confusing. It's likely that the chart of potash prices from the NASDAQ looks wrong. It's either long-term contracts that aren't updated very often, or it's just wrong. But every other source is reporting strong rises in potash prices last year. However, there will also be a component of the UK potash price, which is a reflection of international shipping rates, and those have come back down. And so all things being equal, you would expect potash prices to come down a bit for UK farmers, but all things are not equal because Russia has just invaded Ukraine. So anyway, thank you to Albert S. for his input on this. Okay, moving on to equity markets. Richard.
Yeah, thank you, Keith. So equity markets had a pretty generally a bad week. FTSE All Shares down 3.5%. The stocks Europe was down 4%, so 9% year-to-date drop. S&P 500 is down 10% year-to-date, and Nasdaq down 14% year-to-date, which is very significant drops. Topics 2.5% in the week and nearly 6% year-to-date. Bitcoin still having a bad time despite that epic bounce yesterday. Still down 17% year-to-date. The pound against the dollar down 1.5%, most of which I think was yesterday. There was a big move against the dollar yesterday, and the dollar index up 1%, again, most of which I think was yesterday. As Keith mentioned, a bit of a flight to safety.
Now, this is interesting because it seems to show you have strong flows into the equity market during Fed tightening cycles. Now, this may well be because the Fed tends to tighten when the economy is doing well. So
they also signal it a long way off, don't they?
Yes.
So if people are reacting to it because it's beginning to be signaled a year or year and a half prior to it actually happening.
And retail investors continue to pour money into the US equity market. Now, I thought this was an interesting chart. This shows the performance of the MSCI US in orange and the MSCI World ex-US in white. And you'll see the two lines tend to be mean reverting on a very long time scale. And the US has had this absolutely extraordinary outperformance. And you do wonder whether the two lines are going to start coming back towards each other.
That would be very unpleasant for the US market, really.
Yeah.
It would suggest 30 to 40% drop.
Yes. Or looked at another way, Richard, maybe the white line is going to shoot up by 50% or more to join the MSCI. Given the geopolitical risk, I think the former is more likely than the latter.
I'm not getting optimistic, Keith. I refuse.
And on that note, the ratio of negative to positive earnings guidance in the US has now reached over 3. So 3 times more negative changes to earnings guidance than positive ones. That's not good for the market.
No.
And a reminder, the US is extraordinarily expensive in terms of the cyclically adjusted PE ratio. It's only been more expensive than this during the dot-com bubble. And we know what happened next. But something to cheer us all up. So this is the relative performance of hedge fund managers. We don't do so bad, Richard. They're down 21% versus the index. Okay, on to energy commodities. And unsurprisingly, it was a strong week. So oil is up 4% on the week. European natural gas rose 50%, and that's after it fell back a bit this morning. Coal up 3%, uranium up 2.2%. And the numbers that matter in oil. Last week saw continued drawdowns in US inventories. The US oil production was flat on the week and remains below its end of year, that should be 2021, end of year production levels, and the rig count ticked up by 4. Now, a reminder that the world uses an enormous amount of fossil fuels. Renewable energy is this little yellow line at the bottom here. So it's going to take us a long time to wean ourselves off fossil fuels.
There's
And
also,
John.
there's a remarkable lack of realism in amongst environmentalists. I support, in looking after our environment. We shouldn't be damaging our rainforests, driving species to extinction, destroying our oceans and so forth. Absolutely, we shouldn't be doing it. But I read there was a letter in the FT this morning where a very short letter, but basically I think it was talking about Denmark. I forget which. Basically, the letter said we need to be moving to more. Fundamentally, we need to be moving far faster to fully renewables, and it's like it just doesn't work. And in order to have a sensible debate discussion, both sides need to acknowledge the validity of the other side, and we don't really seem to have that at the moment.
No, I completely agree.
Think, yeah, and it's quite alarming, really, because it's a religion that renewables are the only solution, and renewables are a problem without other sources of energy.
Yes, but I mean, that lack of debate, Richard, is frankly one causes of my big trade on oil prices, in that certainly in the UK, you can't have a rational debate about this. During the week, BP was forced to cancel its sponsorship of the National Portrait Gallery because activists had basically thrown themselves on the floor and covered themselves with oil and said it was politically unacceptable for BP to sponsor anything. And so, we're in this environment where fossil fuels, which we rely on for like 80% of our energy, are persona non grata. And if you can't invest in them, if fossil fuel companies can't invest, then there's going to be a fundamental shortage and the prices are going to go through the roof.
Yeah.
And on that note, here we go. Crude oil. This is WTI. It's 95. Brent is at close to 100. And, this is what we were just talking about. It is CapEx in the US energy sector. And you see that back in 2015, when the oil price was doing very well, it was above 300 billion. It is now 71 billion. So much less investment in oil, even though we consume it at a record rate. And reminder that OPEC still have spare capacity, and they're meant to be reducing that spare capacity steadily by increasing production by 400,000 barrels a month until they've run out of spare capacity. Now, it's an open question whether the invasion of Ukraine will force a rethink by the Saudis and get them to open the taps and ease very high oil prices, and that would be good for the world economy. OPEC is struggling to meet its own output targets, and as we have discussed previously, there are a lot of questions whether OPEC actually has all the spare capacity it claims, but I think it's still certainly got some, and I would estimate about 1 million barrels a day could easily be brought online. Going through a chart pack of graphs from John Kemp at Reuters, and he shows the price of retail gasoline in the US and current price compared to history. So the current price is the dashed grey line. You'll see it has previously gone much higher. So we're about mid-range, although notice that it's generally not at very high prices for very long, because that tends to induce a recession and the fall in the price. And because of that, oil prices are very strongly cyclical. So this is the year-on-year change. And whenever you get very strong rises in the oil price, changes tend to come straight back down and then go negative. And you see that big rises in oil prices tend to be followed by recessions. So
Keith,
gone.
something interesting about this is that so price of oil rises significantly. A recession is caused because the cost of production goes up significantly, and that reduces oil demand, and price of oil drops. And that's in a sort of steady state scenario where oil production isn't particularly constrained. But we're moving into an environment where oil production is going to become increasingly constrained by the lack of capex and can't be deconstrained quickly.
Yeah.
So does that mean that the next recession will be longer and nastier than these recessions, because it's going to take that to reduce oil demand sufficiently to allow the price to drop back down?
I don't think so necessarily, Richard. I think what you could get instead is just a very volatile economic environment, which is kind of what I'm betting on, actually.
Yeah.
So I think what happens is that we have constrained global supplies of energy, not just oil, but gas and coal. And as the economy grows, and it's currently forecast to grow quite strongly, it uses up all spare capacity, energy prices spike, that induces recession, activity drops sharply, at which point energy prices normalize and we go again.
So you're thinking the world economy becomes more volatile?
Yes.
It cycles up and down faster.
Yeah. So my plan is, when oil prices get very elevated, you sell, move to cash, wait for the crash, and then start all over again.
Okay.
Now, this is where we are. So the yellow line is global oil consumption, which spectacularly crashed during COVID, whereas production was cut hard by OPEC and is coming back slowly, but it has been lagging consumption. And so we've had continued inventory declines, as can be seen here. So below the line is more consumption than production. As a result, the increase in global petroleum inventories during the COVID has now been entirely consumed. And inventories are getting towards their lows over the previous 2 decades. So if that continues, oil prices are undoubtedly heading even higher. And oil consumption is not yet back at trend. And we know that international air travel has been very subdued and is now starting to come back. Futures markets are signaling continuing tightness in oil markets. And this is global flights. People have started flying again. The purple line is 2022, way above 2021, although some way below 2019. Okay, Dutch natural gas futures had a big spike yesterday, but they've come back a bit today. I think it's going to take a while for all energy markets to settle down. We just work out what the impact of the invasion will be. Because, as Richard was talking earlier, Europe imports a load of energy from Russia, and the high price of gas from Russia has meant that German imports from Russia have gone up in value.
Interesting. I mean, the problem with the German position is that fundamentally, sanctions against Russia need to be economic sanctions.
Yeah.
So that is no gas exports, no oil exports. And Germany simply can't afford that. So in essence, Germany has to throw Ukraine under the bus in order to sustain its energy supplies.
Yes. Yeah, absolutely. Coal continues to steadily climb. uranium ticked up a bit.
So I saw that one of the Northern European countries that operates nuclear reactors has said it won't be buying uranium from Russia.
Yeah.
Announced that yesterday. And if that becomes widespread, then what will happen is I don't know what proportion of supplies come from Russia, but that would take Russian uranium supply out of the market.
Yeah. Maybe Cameco would have to reopen some of their uranium mines.
Yeah. So now we're looking at the industrial commodities, which pretty much universally had a good week. And yesterday there was huge volatility in the commodity market all over the place. A lot of which actually has reversed sort of overnight and this morning. So aluminium up 4.5%, cobalt nearly 2%, copper pretty much unchanged now for quite some time. Chromium unchanged, iron ore continuing iron ore is extremely volatile. That is becoming, you wouldn't have expected that iron ore would be a volatile commodity, but it has recently, let's say over the last year or so, turned into a volatile commodity. Lithium just on this parabolic upward move. Magnesium, a lot of which is produced in Russia, 10% on the week, reversing half of the year-to-date decline. Neodymium unchanged. Nickel up, steady. Nickel is just steadily rising. It's a lot of its consumption now is in lithium-ion batteries for cars, and there is as we report regularly, there is a supply deficit of lithium, very low inventories. Tin is continuing its relentless rise, and ferrovanadium is continuing to decrease, and up 30% year to date, significant increase. And just running through the graphs, the aluminium is on a strong uptrend, as is cobalt. Copper continues to consolidate around about the 4.5 level, dollars per pound. Chromium. Now, when I said iron ore was very volatile, and look at that, it doesn't actually look particularly volatile.
Well, those are enormous ranges, Richard. That's gone from $225 a ton to 75.
Yes, but I was just looking at it on a weekly basis, it doesn't look particularly volatile.
Yeah.
Anyway, lithium carbonate will stop at some point. We just don't know when.
Absolutely astonishing.
Magnesium. Neodymium, huge demand from wind turbines. Nickel continuing its relentless climb. And tin, likewise, continuing its relentless climb. And ferrovanadium, nearly actually back to its peak of last summer.
Yeah, joining the party.
Yes, I wish Ferroalloy Resources would join in the party, because it isn't.
Well, the trouble is, I think
subject to some political uncertainty in Kazakhstan, yes. Isn't it?
Exactly. Now, but as we go through these, the rise in green technology metals, when we talk about the energy transition, I mean, it is assumed that there's just an infinite supply of neodymium and copper and all the lithium. All these price charts are showing that that's just not the case.
I mean, we're already in an environment where the environmentally friendly energy consumption and production are operating with very constrained resources, which inevitably must slow down the rate of growth, or alternatively make energy much more expensive. Well, both, in fact, because supply is constrained. Precious metals had a reasonable week. Gold up 1%, silver up 2%. Platinum unchanged, really. Rhodium up 10% and 40% year on year. Palladium up 30% year on year in a strong week. But precious metals are showing signs of life. They haven't really shown signs of life for a while. They're all prices are starting to pick up and maintain a fairly positive momentum at the moment.
Yeah.
So we have gold, silver. Silver really needs to get above 28 if it's going to break out of its trading range at the moment. Platinum just looks fairly boring, really. Rhodium.
Well, rhodium is a very good example of a commodity with very high price demand inelasticity. So essentially it only has one use at these prices, which is in catalytic converters. And when the car industry closed down, you saw a huge drop in the price. And now the car industry is getting back to work. The rhodium price is rising very quickly.
Palladium on a decent upward trend at the moment.
Well, given that 40% of world palladium comes from Russia, I'm surprised this hasn't spiked higher.
Yeah, but then car production is not doing great, is it? So maybe a bit of a trade-off between the two. But you're right, Keith, you would expect it to be a bit higher.
So moving on to rates. Well, a slightly surprising week in rates in that they continued to rise and there wasn't much safe haven buying. There was some safe haven buying instinctively on the open in the US yesterday, but then by the end of the day, the bonds had actually closed down. And in the periphery of the Eurozone, bond yields also spiked up a bit, but not by much. So running through the charts is the Greek. And the ECB saying that it was possibly going to pause or its rate rises has been good for Greek 10 years and for the Italian as well. UK 10-year gilt yield has ceased rising for a bit, although it is up on the week, and that's the US. And, well, if the seasonality chart is anything to go by, then we start building from mid-March and we get into a strong period for equity markets before we get to sell in May and go away.
The question in my mind really, Keith, is does Vladimir Putin also read this chart?
Well, he's invaded, given that we know that equity prices tend to rise after an invasion. He's been watching it, Richard.
His timing, he's got his timing right, hasn't he, Keith?
So what did you get up to this week?
Thank you, Keith. Well, this week, I got up to precisely nothing. I was up very slightly. So yesterday for me was a bizarre day because at one point gold was up 4%, silver was up 5%, I think, and that was before the US market opened. So I was expecting my precious metal miners to be doing extremely well, but they didn't because gold fell back down to slightly down on the day, I think. So that was a real sort of a roller coaster. I was glad I wasn't trying to sort of move in or out of the market because it's so volatile. It's impossible to get your timing right. So for the week, I had a tiny change. Obviously, the FTSE All-Share had a bad day yesterday. And my relative performance 6%. But really, if you look at the absolute performance of the year, 2.6%, it's fairly mediocre, I would say. And I am consistently sitting on my hands. I am actually, though, I am wondering when the right time might be to, you'll laugh, Keith, to buy the NASDAQ. And I'm not saying it's now, but at some point that time will arrive. And so I'm just sort of a little bit like the cannabis ETF. I'm just keeping my eye open and wondering when to dip my toe in the water, but not yet.
Very good.
How about you, Keith? What did you get up to during the week?
Well, I had a pretty terrible week, frankly, down 3.5%. UK banks got very badly hit. I have a decent exposed UK banks. Essentially, there's going to be a lot of financial disruption, and the time scale for interest rate rises is probably going to be delayed, or that's bad for banks. In addition, strangely, the oil price shot up, but a lot of oil companies actually dipped.
Now, I did notice that, and particularly the small oil companies, they got knocked very badly, didn't they, Keith?
Yeah, absolutely.
Why, is that just because the type of investor who buys those companies tends to be a small investor who gets very jumpy and nervous?
Quite possibly, Richard. That would be the best explanation I can think of. I don't know.
Yeah, because the bigger oil companies were either up or not, didn't drop, did they?
Shell's down from its highs. BP got badly hit because, obviously it has a big stake in Rosneft, as we have discussed.
Yeah.
Most of the other oil companies have actually had a bad few weeks, actually.
But interestingly, the thesis that is very much intact, isn't it? The oil prices continue to go up, and all of the analysis suggests that there is a continuing deficit in production. So the thesis is right, but we've got a very volatile period of time at the moment where you have to hang on to your holdings. Yep,
absolutely. So, I'm still up 5% on the year. Great. But bear in mind that UK inflation is running at 5.4%. So,
running to stand still.
Running to stand still. Now, I have got the whole Russia-Ukraine situation wrong. So earlier in the week, when Russia declared it was going to recognize the independence of the two separatist enclaves in eastern Ukraine, I thought, he's done it. That's it. He's now going to walk away. Crisis over. I'm going to buy some Evraz, which is a Russian steel maker listed in London. I believe it's part of the FTSE 100. And its share price is then down like 60 or 70%. And I thought, well, that would be like a 2.5 bagger if things return to normal. But I then sat down and thought about it and thought, have I been impetuous? And having watched Putin's speech, I thought, actually, I don't want to hold all this. So having built up a 1% stake, I then sold 80% of it. And that proved to be a good move, obviously. And yesterday, I closed out my small remaining stake, and overall, I had a loss of 7.5%, and that cost me 0.1% of the portfolio. Now, I actually closed it on moral grounds, in that I just don't want to hold any Russian assets from now on, frankly. I also, talking about on moral grounds, I also closed out my position in Kistos, which we talked about last week, which has announced this egregious management self-enrichment scheme. And as always, whenever I take a moral position on anything, it always costs me money. It's cost me money. The shares are now way above where I sold them. There you go. And I've continued to sell down my tallow oil, which is heavily indebted and not doing terribly well. So I bought and sold Evrad's Capricorn Energy. Actually, I've got a 4% weighting and a 4 out of 5 conviction, although I failed to fill in the table. Okay, going through some charts. So this is Evraz. You see, back earlier in the year, it was over £6. I bought it at £2.60 and then thought better of it and sold it again. And then the remaining tiny bit I sold yesterday. It spiked up a bit today. Now, one of the causes of my losses this week was that I earlier bought this Ukrainian iron ore manufacturer for Expo, so iron ore producer for Expo, and obviously its shares have taken a huge hit on the Russian invasion, which obviously I was not expecting. And today it announced force majeure on all its contracts because the rail network has been suspended. So it can't actually deliver its ore. So Capricorn Energy, which we have talked about previously, great news. It has settled with the Indian government and received the $1 billion in tax rebate from the Indians, and the share price ticked up only a tiny bit on news of that, and they will now have the resources to launch a 700 million share buyback. So, I can't see any way the shares price won't rise from here, frankly. Petrometad, it announced an operational update today, yet more delays, essentially. I urge you to read that if you hold the shares. Tecmar has had an absolutely terrible month. Tecmar is Portfolio Matters ESG investment, and it's not doing very well. It's launched a placing of 4 million at 45p, and it's just announced results for the last 18 months, and it lost money. But wind power is growing. It's heavily exposed to the wind sector. So, hopefully we might get our money back. And on that note, it's a very volatile period for world markets. We are just going to have to see what happens. But historic experience has shown that actually equity markets tend to do well after the shooting starts, although we would expect to see continued disruptions from commodity prices, and the danger is of stagflation. We will be watching events closely in the weekly, so stick with us. In the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.